Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, February 25th, 2020, and what a day we had yesterday in the market. Got a lot to go over today, and I tell you what, there's so much to go over. I think we need to just jump right in. As far as today's agenda goes, we got quite a bit on tap. We'll go through and do our daily market recap. We will go into talking technically. I want to talk a little bit about the S&P 500. After the big drop yesterday, the Dow Jones lost over 1,000 points. The S&P was down more than 100. I think it's important to take a look at what we might be looking at down the road, start to plan a little bit more if the fear level picks up. So we don't want to be caught totally by surprise. I think a lot of folks were caught totally by surprise yesterday. I was one of them. And then we'll get into earnings spotlight, talk about a number of companies that reported earnings, getting some big reactions in both directions, upgrades and downgrades. And then we'll end the show as we always do with three you must see. Just three charts. Yesterday, I honestly, I could have picked 1,000 charts because there was so much activity. But just, some of the better looking charts that I've seen, some of these pullbacks may be opportunities. We don't know at this point. We want to see how much this fear ramps up. But the pullback, everybody's been waiting for one. Then you get one, you're afraid to buy. And I get it. It's not an easy decision. But, they're clearly prices are better today than they were yesterday or last week. And so that certainly could be an opportunity. We'll talk a lot about that. All right. Got an upcoming event on Friday. I've been invited back to Benzinga's pre-market prep show, which they do every day in the pre-market, and I'll be appearing on Friday at 8:35 a.m. You can listen in. I'll probably be talking for about 15 minutes, but I was on the show back in October, talked a lot about the bullish setup in the market and how I was very bullish. And of course, now 4 months later, the market's gone up quite a bit. So they've asked me to return. I'm going to be on there Friday morning, 8:35 a.m. So if you have any interest, you can join me at premarket.benzinga.com. And when you go over to the website, let me just point it out real quick. Here is what you'll see. So it's basically a screen, TV, kind of a little bit what you see here on StockCharts TV. And I'll be on there, giving my update on the market, and I will join them right around 8:35 a.m. on Friday, and that's Eastern Standard Time. All right, let's move on to the overall market and what happened on Monday. It was not pretty, that's for sure. As you take a look at the market here, you can see the Dow Jones down 1,031 points, the S&P 500 down 111, the NASDAQ down 355, mid-caps down 62, I can go right down the list. We can look at a lot of the sectors that did not perform well, energy and technology. I will point this out. If there was one positive, if you think about it, the Dow opened down about 900, finished down 1,000. So it wasn't a lot of selling after the open. Most of it was the open, and we had a lot of buyers anxious to scoop up shares. In fact, if you look at the NASDAQ, we actually closed above the open. So yes, we were down 3.71%, and prices are lower, and everybody's portfolio balances are lower if you're on the long side. But it wasn't one of those trend days where you see the market gap down, the Dow gap down 100 points and then sell off 900 more. So, I know maybe that's just a small silver lining, but it's one thing I think we need to think about, that this is something that maybe is just maybe a little bit of preying on fear at the open, and then a lot of buyers there to scoop up shares. We'll see. And where the market goes from here, I think, is going to be really important, and I'll get into that in just a minute. 10-year Treasury yield, though, we do have a couple of economic reports coming out later this morning. Actually, one just came out, December Case-Shiller HPI. It was slated for 0.5% increase. I have not seen the report just yet. It should have just come out. Also, the December FHFA House Price Index expected to rise 0.3% at 10 a.m. this morning. February consumer confidence will be out. The expectation there is 132.5. I just wanted to point out here on the 10-year Treasury yield, you can see the major level. This is a 10-year chart of the yield, and we are now down Let me get the latest, make sure I got the last tick here. 1.364. And you go back, 1.33 and change was the all-time low that we saw back in 2016. So we were right at that level right now. Personally, I think the bond market is screaming to the Fed to lower rates. I've talked about this a lot. I think now with coronavirus fears and the impact that that could have on global economic activity, I don't think there's any doubt in my mind the Fed should be lowering. They've got a big meeting that's going to come up on March 17th, March 18th. And I can only say this, during the trade war fears, when the Fed did not act or didn't act the way the bond market thought, that's when we saw a big decline. And so if we get to the 17th, 18th, the market's still holding up okay, and the Fed doesn't come through, that's where I would be a lot more concerned about the market. So just kind of mark that on your calendar. That's going to be coming up in a few weeks. But I'm going to go into talking technically, and I actually want to start by showing you an Excel spreadsheet. You know, this is a pretty important historical fact that I think everyone needs to be aware of in the market. And so what I've done on my Excel spreadsheet is I've looked at the S&P 500 since 1950, and I've got every day's activity in that Excel spreadsheet. And I use it just to go through and look for different trends and so forth. And I want to just point out, if you're not aware of this, I think this is pretty impressive data. When you look at the way the market performs, I've got the annualized performance broken down by calendar day of the month, not February, but this is the first of every calendar month. So January, of course, January 1st is closed, but you got February, March, April, May, rest of the year. All of these, this is the cumulative performance of all first of the day of the month, second, third, fourth, and so on. And when you look at the annualized performance, think, first of all, that the average annual return since 1950 has been about 9%. So if every day was created equal, we would see these annualized performance numbers somewhere around 9%. Well, you can see the first of the month is 46.45%, second 34, then 25. Beginning of the month, there's a lot of money flow coming in from pension funds, from 401ks and so forth. You got a lot of money that drives the market higher at the beginning of the month. Then there's the anticipation of that money coming in. You've got the 28th down through this, actually starts maybe around the 26th, but really picks up the 28th through the 31st, where I believe you've got portfolio managers, hedge fund managers, market makers, anyone else knowing that money is going to be flowing in. They're doing this legal form of front running. In my opinion, that's what it is. You know money's coming in, you're buying ahead of it. So this period, though, when you look at it from the 26th to the 6th, since 1950, the annualized return is 20.87%. And based on the number of calendar days, I mean, this return, if you were only in the market from the 26th to the 6th every month since 1950, you would be almost as well off as if you just left your money in the whole month. So in other words, the 26th to the 6th essentially represents almost all of the gains in the S&P 500 over the last 70 years. The 7th to the 10th is a bearish period. 19th to the 25th is a very bearish period. 11th to the 18th is bullish. But when you look at the three groups, these three periods, and combine them, they're almost a wash. So it's really that 26th to 6th period that really drives the market. You need to be aware of that, especially if you're a short-term trader. But the one I want to focus on right now is the 19th to the 25th. Market topped last week on the 19th. The 20th and the 21st, the S&P 500 was going down both days pretty significantly. And I had a webinar last night with Earnings Beats members, and I wrote about in my Trading Places blog over the weekend about how I believe that prices were directed lower. Just my personal opinion, take it or leave it. But there were a lot of net in the money calls that were on the table as of Wednesday. And I actually went through some calculations showing some pretty impressive reductions in those net premiums that had to be paid from Wednesday's close to Friday's close. In order to get prices down, market makers would have to short prices. They'd have to short the market. And I just find it odd that you've got these financial firms that have market making wings that are certainly have the incentive to drive prices lower Thursday and Friday. And then you wake up on Monday And many of these same firms, not their market making units, but maybe their research departments, are coming out lowering GDP. Hey, it's just my opinion, but I wouldn't be surprised. I mean, the amount of money that was on the table as of last Wednesday to what was lost, you and me losing money between Wednesday and yesterday was quite large. And, just it's worth it to raise the point. I have no idea whether there's an impact there, but historically, the 19th to the 25th is the worst time of the month. It just so happened this month, 19th to 25th, really took a hit. Today is the 25th, by the way. So we start this bullish 26 to 6 period starting tomorrow. But I thought it was big enough to at least bring it up, and you can draw your own conclusions. All right, I want to go back down. I want to take a look at the S&P 500. So let me bring my charts back up for you. And let's talk about the S&P. So here on the S&P 500. So now we are where we are. I don't care how we got here. We are where we are. You can see that we were up near 3,400 on the S&P 500 on Wednesday of last week. We sold off down to about 3,330 or so. And then yesterday we had the big 111-point drop. We're down 32.25. Now from top to bottom, this is just an estimate, but it looks like we're down about 5.5%, maybe 5.3% from the top to where the low was yesterday. And so it almost looks to me like potentially anyway, left shoulder, left side of the neckline, head, right side of a neckline. If we do bounce here, over whether it's a couple of days, whether it's a couple of weeks, whatever, you might want to just watch and see maybe if a right shoulder goes in. And then if we were to come back down and break this neckline, then I think we've got some technical problems to go along with maybe some fundamental issues as well. So that's maybe something just to be thinking about, keep on the back burner, and just know that this low is a pretty important low in the short term. We've tested this 32.20 area quite a few times. 32, actually, I think the number is around 32.14. But if we break below that, I think that certainly will open up the door to more technical selling. And if we get more selling, we're going to see the fear ramp up. We get the fear ramping up. We're going to see more selling. Then, selling can become more impulsive. And so we got to watch this level. I think this is a really important short-term level to keep an eye on. If we do break down, the next key support level would be that early December low. And that would be about another close to 5% drop from that 32.14 area. So the measurement would almost be made down to that level. And remember, the big breakout was at 3,025. So if we were to head down there, we'd probably get our measurement, maybe even a little bit more. So those are some levels to think about. Now, I also want to show you this chart on the S&P 500. And down below is the VIX, Volatility Index. And what I've done is I've stripped out the daily data on the VIX. I have a 5-day moving average. And the way you can do that is go down to indicators, price, put the VIX in, $VIX, style, make it invisible so you don't get the data showing up. And then overlay, you have a 5-day simple moving average. So invisible gets rid of all the noise, and the 5-day simple moving average smooths everything out for you. But when you look at the market, when we get up into this area, we hit a 5-day moving average on the VIX now to 18. When you get to 18, you start to get to levels where some shorter term bottoms tend to hit. So, here we got up to about a 5-day moving average to 23. Here was about 18, 18, 19. Let's forget about these red circles for a while. 20, 20, 18, and we're at 18. All of these black arrows point to these kind of shorter term kind of bottoms that the market. So we get the fear up to a certain level, we print a bottom, and then we go on about our business. That's where we are right now. That's why I think this 32.14 level is pretty important. If you break 32.14, the fear starts to pick up. Then I think you got to start looking at potentially, I don't know if we get all the way up there, but you got to start looking at potentially these 5-day moving averages to get up into the mid-20s. They have marked very significant intermediate term bottoms. Now, anything up into the 30s, and I think we'd be talking about, really significant lows. I think if you get into the 30s, we might even get all the way back down here to about 2,800. I'm not saying that's where we're going. I'm just saying, hey, we got to be aware as volatility picks up. There's one thing that, technicians, technical conditions don't seem to matter when the market gets really fearful and that VIX picks up too much. So I think it's really important for us just to keep that in mind. I'm still extremely bullish the market, but I'm not going to ignore what's going on in terms of the coronavirus and the fears and the global economic impact it could have, and the market getting fearful and support being broken, I mean, that would be a perma bull just to always say great things no matter what. I mean, we have to be, objective. So what I see in the market, I'm still very bullish, but I'm also conscious of what's taking place in terms of support levels and these VIX readings. So when the market gets fearful, one of the things you can look to is gold. I'm not a gold fan, but gold is performing extremely well right now. Probably a little bit too well. It's gone up a lot here over the last couple of weeks, especially the end of last week and yesterday. My biggest concern with gold isn't the fact that it's been, that I don't think it's going to go higher. It's actually been in a pretty nice trend. My problem with gold is that it hasn't been doing as well as the S&P until probably the last week or two. Now it's actually been outperforming the S&P, and we're going to need to watch that, especially if the VIX breaks down any further. Another area to watch, energy. I mean, I thought, I wrote about energy rebounding, and we did have a little bit of a rebound, but with all of now the fears about global economic growth slowing with the coronavirus, you've got the XLE breaking back down again. And when you get into a breakdown mode, I think you got to forget about the bullish calls. I mean, if I was in it and I was bullish and I got that breakdown yesterday, I don't know that I would be necessarily rushing out to sell right now, but I would watch this weekly chart because you've got key support here in the low 50s from the end of 2018. And then you've got mid 40s down here in 2016. I don't want to hold it all the way down to there. So I really want to watch these fourth quarter 2018 lows. All right, let's move on to earnings spotlight. Number of companies out with earnings. Intuit, let's start there. They beat on their bottom line, $1.16 versus $1.02. Stock is up 3% in pre-market. This is kind of what I was talking about. We see so many charts. I mean, I could have used this in the three you must see. We had good support at 280. We got the 50-day moving average at 279. Stock yesterday came down, hit that 279 level, and bounced right off the 50-day moving average. Now they come out with good earnings. Stock is up 3%, which is, what is that, $8, $8.50, something like that. So we're going to be looking at maybe somewhere around 295 on the open based on the last price I saw. So that's not a breakout. I think Intuit's probably still in this trading range and it's going to watch to see what happens with the overall market. But that is a key support level to keep an eye on down around 279, 280. Another earnings report, and there actually were quite a few and some pretty interesting reactions to earnings. Home Depot came out this morning. Easy beat on the bottom line, $2.28 versus $2.11. Stock's up 3% in pre-market. That would be about $7, which will take it up to about $2.46. And that's about where its candle body high is. Back from Thursday of last week, the high was $247.02. That's on a closing basis. The open on Friday was $246, so $246 and change. So $247.02. Do we open above that level on Home Depot? If we do, I think that's a bullish development on the stock. Looking at it technically, you can see home improvement recently broke out. It's pulling back a little bit here. Home Depot, though, has been starting to show some nice relative strength relative to the home improvement group and relative to the S&P 500, and the group overall starting to strengthen. So not a bad looking chart. And again, good solid earnings results and a nice reaction from Wall Street so far. We'll see whether or not we get that breakout on the open. If we do, I think it's got a better chance to continue that move to the upside. All right, those were a couple of the big names. Now I'm going to give you some other names that are getting some pretty wild reactions. First, I'm going to start with PANW. And while I'm doing this, I'm also going to go over here and I'm going to pull up this symbol summary. Make sure you check this out if you haven't already. It's a pretty cool new feature. But you can see the pre-market is now shown on here. So pre-market on Palo Alto Networks right now down almost 15%. And you can see the stock here, 237.33. So that price where it's looking to open right now would be 202. You go over here to the chart, 202 is all the way down here near the support level. So if it opens at 202 and goes down to say 190 and then comes back up through this support level, the worst could be behind it, at least in the short term. But this is a really bad reaction to the report. They actually beat. I mean, it was $1.19 versus $1.12 on the bottom line. I didn't see their forward guidance, but I'm assuming with this kind of reaction that maybe their guidance was less than expected. A positive report is Keysight Technology, KEYS. We'll go over here, take a look pre-market, what's going on. KEYS up 10% pre-market, up to $100. Where is that on the chart? $100 is right here, still at about the 50-day moving average. It's still in the middle of this wide range. You've got gap support. I'd really watch this gap support over down here around 89 bucks. Wouldn't want to lose that. So I think you're in a trading range, 89 to 110, and we're going to open right in the middle of it at 100. Let's see, what else do we have? CSOD. This is Cornerstone on demand. What's this doing pre-market? Stock beat bottom line, by the way, 43 cents versus 33 cents. Stock down 9.4%, 49.86. 49.86 is below everything on this chart. So again, I would watch to see what that opening price is. I show support at 50.01. Last trade 49.86. So it looks like right now it may open below that key support. If it opens below the key support and then starts to rally a little bit and fails and then goes back down to new lows, I think that could start a bigger sell-off. If it holds this support level and goes down beneath it intraday and then rallies back, we could see the market, finish up pretty strong, or this stock finish up pretty strong. What else do we have? How about Shake Shack? So Shake Shack, market not happy, down 15% on Shake Shack this morning. So 62-ish, so we're talking about way down here. This stock's been downtrending. Look at the relative weakness since it topped several months ago. Not exactly a fan here on Shake Shack. They did come in with numbers that beat 6 cents on the bottom line. The market was expecting a loss of a penny, but stock again down 15% pre-market. MMSI, this one was up 10%. Let's see what it's doing here pre-market now. Up 7.8%, 41.80. So we look at 41.80 on the chart. What is that high? Right in here, the candle by it's 41.02, 41.07. It looks like it is going to open up above that level. I think it could make a run for this gap support right here. Bottom of gap support, which was $44. I'd be a little careful there. Maybe one more here. Let's see here. Lending Tree stock is down. Actually, let's do EverQuote. This is actually in one of our portfolios, not getting a very good reaction at all today. Closed at 45.74. I think last time I looked, it was 41 and change. I thought the report looked really good. They beat top and bottom line. They actually raised some guidance. The stock's coming back a little bit pre-market. It was down to 39 and change. I couldn't understand it. I don't even understand the 42.90, but it is still down 6%. 42.90 on the chart. Still is above the 20-day moving average, which is at 41.04. Maybe keep an eye on that. But this has been a stock that's made a big move. So you're probably going to see a lot of volatility today. I wouldn't be surprised. Big moves in both directions. It may be one of those, indecision candles, a high wave candle, something like that. But internet stocks overall have been pretty strong if they hold their support level. This has been one of the strongest stocks in the internet group, so something to keep in mind. Lending Tree, I've mentioned that one, so let me just show you that real quick. Lending Tree came in. They did miss on their earnings. They came in at $1.12 versus $1.40. Stock down 9.7%. That's, what was that, 308? Yeah, 308. So let's pull this up quickly and we'll get it quick. A couple upgrades and downgrades. Yeah, it's going to be down below its 20-day moving average. This is a stock that had been under a lot of pressure, recently rallied, but this is not likely to continue based on a big miss on its earnings. I would expect maybe these bottoms down here around 280, 290 to come back into play. All right, let's move on to upgrades and downgrades. I want to start with AMCX, AMC Networks. Stock's being upgraded. I look at this chart and I just want to know why. It's been going down relative to the broadcasting and entertainment group for quite a while. It's broken down. It's got terrible volume trends. I see nothing on here I like, so I would not be a fan of this upgrade. Wouldn't agree with it at all. The next one, however, I do agree with. Aon, this is a company that is in one of our portfolios as well this quarter. I think it's in our income portfolio, but the move up, we've seen a little bit of a pullback. It was overbought, but it's one of the strongest stocks within the insurance brokers group. And insurance brokers have been breaking out versus the S&P. So I think this pullback's an opportunity. I like the upgrade. Another upgrade in the biotech space, got to agree with this one as well. REGN up 5.5% yesterday. Didn't see too many stocks doing that yesterday. But the stock did go up on a lot of volume. It has been improving relative to the biotechs for the last 8, 9, 10 months. It is now at a high for that period on a relative basis. Same goes versus the S&P. And I actually like biotechs. I think the biotechs, they were down quite a bit yesterday. They rallied back a little bit midday. I still think this is a group that you want to keep an eye on for the next breakout. Let's do one on the downside. How about Micron is being downgraded? Micron, a key support level. This could have been in the 3 you must see. Very important support level. It looks like around 52.5. It's being downgraded, but it has been a pretty good performer in a strong group, the semis. Semis have been beaten up. If we get a bounce, I expect semis to bounce with it. And so I don't know about this downgrade. I'm a fan, although I do think you got to watch 52, 52.5 here, and then this breakout occurred at about 51. So that's going to be a key area of support on any pullback. All right, 3 you must see. So let's take a look at a few charts here, and then we'll wrap up the show. Lockheed Martin. First thing I want to do is show it to you on a different chart. Because Lockheed Martin did what a lot of stocks did, and that is, as they moved up to the last high, look at that PPO rolling over. So you got higher price, lower PPO, and when you moved up to that new high, look at the volume drop off. So there was a lot of slowing or signs of slowing momentum here, both in terms of the PPO rolling over and the price or the volume dropping off on the latest high. And so some of the selling could be attributed to just the fact the market needs a little bit of a pullback. So Lockheed Martin, I thought, was one. Watch this 50-day moving average. When I see negative divergences, that's what I look for. 50-day test, a center line test on the PPO. I suspect we'll see LMT recover at some point, especially if the overall market recovers. But yeah, this is a level I'd watch pretty closely down to 50-day. Next up is MKSI. This is a stock in the semi group as well. I'm going to pull this up on a relative basis. I think it's pretty easy to see. First of all, semis have been strong. This has not been one of the best semis. And so when I look at a chart like this, it hasn't been one of the best stocks in a group that's been really strong. I don't want to lose a key support level. I'm not going to annotate just to save time here, but you can see the breakout occurred right at about this 102 area. And when we gapped up, when we came back down, we held the 102. Well, we've had a number of tests here at 105. I think we're into this zone, support zone. We really want to watch MKSI. The last stock I have here is Xerox. Xerox intraday yesterday was breaking down below a pretty important low. I will quickly annotate this just to show you that price support level, this gap support. There's the gap up, heavy volume early November. We went down, tested it. We looked like we were breaking down yesterday on big volume, increasing volume, and then we reversed and came back up. It's a nice kick save at support. So I think Xerox is one that I would keep an eye on today. I would be expecting a recovery here. All right, that is it for today. I want to thank everybody for stopping by. Remember, I'll be back here on Thursday. I'll be over at Earnings Beats tomorrow, and I'll be at pre-market prep at Benzinga on Friday. Everybody have a great day. Happy trading.